Hey folks, good morning. Can I get a sound check? You guys hear me? All right, thank you for that. Sorry, I was having a little bit of issue this morning. I was trying to get OBS. It's the software that I use to do all my video recording. Trying to figure out how to get that to work, but that didn't work out. So I apologize for getting this late start. And really, this is kind of a pilot thing that I wanted to test out, see if this is something we can do on the weekends, maybe Saturday or Sunday morning. So, but it looks like I do have the feature to share my screen right in YouTube. So, really kind of new to the whole um, streaming thing. So, apologize for my noob here. But okay, so good morning, everybody. Let's just see here. We got 14 people to join, so really cool. Appreciate everybody hopping on. I know it was kind of last minute. I just had this idea this morning uh, to just test this out. So what I wanted to do is go over really just an update on my thoughts so far on the portfolio performance and what I'm looking to do in the future, and then really just open up for you folks to ask questions. We can have somewhat of a discussion. I think in the future, probably I'll set up some kind of Discord or something so we can actually talk on the audio. Um, I know we have Eric here. He has his own YouTube channel and stuff, so I've been kind of keep an eye on him as well. So the rest of you folks, yeah. So let me see if I can share my screen and people are joining. So let's see here. Let's see if I can share my screen on this. Okay. All right. Let's see if this will work. All right. So everybody see my portfolio screen. Okay, cool. So I got that to work out. So if there's anybody who's kind of new to this channel, on this channel, I document my journey really using a high yield dividend account as my primary banking system. Basically, all of my income and everything that I get from my employer, my business, um, comes into this account, which then gets invested, and we get the dividends, which pay down the margin. So margin, basically, you guys are probably aware of it. It's money that the broker lends you, and as we're getting those dividends, it pays down that margin amount. Now, currently, I'm not sitting on a whole lot of margin because I've really wanted to de-risk my portfolio. This whole year has been extremely rocky with all the tariffs. It's like back and forth. I don't know if you guys ever seen the Office episode where Michael Scott, I think, gets like a vasectomy, and he says he needs to go snip, snap, snip, snap, back and forth. That's kind of what it feels like with this market. It's like back and forth, always changing. So right now, interest rate is at 5.05%. We had a rate cut this week, and looks like Robinhood is really quick on lowering that margin rate. So really, really cheap margin at this point. So I'm sitting at $52,000 on a margin, and my margin requirement is at $69,500. So yesterday, it's been pretty choppy. I mean, you just saw those fluctuations throughout the day, and it was a very busy week for earnings with a lot of the tech companies. We had between Netflix and Robinhood and um, Google and Microsoft, all those. I guess Amazon was a big one. So um, just a lot of interesting um, events that happened, which I think moved the needle quite a bit. So this is the tracker for WPay. My primary uh, investment vehicle is WPay at this point, and I just built a quick tracker on the performance of the stocks themselves that WPay holds, and you can see how Amazon just been a rocket this week, almost 10% there, and with the leverage funds, we are getting 120% on that. So if we look at AMZ that will be probably around like 12% or somewhere around there. So Robinhood did really well. MicroStrategy, I was kind of surprised that they beat their earnings. Coinbase did really well. We see that Tesla stock is moving up in the green direction. Palantir, Netflix bouncing back. Netflix announced that they're gonna restructure their share prices. So they had a bit of a sell off. I think they were down like 10% or so. AMD, is pretty steady here, and some of the losers for this week. Meta has been really hurt. Facebook, not sure how they're going to fare out. Let me take a look at their stock performance here. Yeah, I mean they went from $676 down to 651 in just one day. Over the course of the week, they went, all the way from 754, so over 12% loss there. All right, let me jump over. I only have one screen up, so I'm going to jump over to the comments here. Morning, everybody. Let's see. We'll start with if there's any questions. If you didn't have margin, what would we be doing with the dividends? Okay, that's great question there. So my whole point with this, for those folks who don't know my background, I guess I can share it here. Um, I've primarily been really investing into real estate for the past 11 years. I have single family homes. It's more or less, I guess, passive. And unless something breaks down, then I gotta do a little bit of maintenance or call somebody. But what I did beginning of this year, I had a property that I kind of was interested in selling as I gained more interest into these dividends. So I sold my property. Um, this was back in February, March of this year, and I took the proceeds of those. Of that property, and I dumped it into this portfolio really. Um, However, outside of that, I still have things that I'd like to pay down. Primarily like my car. I have a little bit of credit card debt, and what I'm really doing with this portfolio. I mean, I what I could do, I could take that money and I could pay all those liabilities off right away, but the whole point of this arbitrage, right? So like, the credit card I have 0% interest on. It expires next year, so like I'm not paying any interest on it. So the way I thought about it logically, like instead of trying to pay that off, and I think its balance is around like $12,000 at this point, but what I was thinking, like instead of just take that money and paying it off, I can instead invest into these high yield dividends, which would pay me the money every single week, every single month, and I could pay that off, and that way I can arbitrage that money. So in the same way, my logic goes with like the car payment, right? So my car payment's like $600 a month, but I was thinking, if instead of, I just take that money and pay off my car, I can make more money by keeping that money invested into these high yield dividends. So Really, the first phase in all of this right now is, I'd like to keep my account, in a big enough portion that it can generate enough income. And as I'm withdrawing those dividends, I'm not reinvesting them. I'm not buying any more shares, and I'm okay keeping that margin at around $50,000 at this point. So everything off the top just goes towards the debt. Now, once that debt is paid off, really the next step is going to be um, to snowball this a little bit more, or to start tackling like the mortgage on my house, or something like that. Which I think for me, I would probably sleep a little bit better if my house was paid off. I had no personal debt, and then I had this income coming in. Then I could really start considering like retirement or something like that, and that way I can then anything extra I can either pay down the margin, or I can go ahead and buy more shares of the funds that I'm enjoying. So I hope I answer that question. All right, let's see here. We'll scroll down to the comments, and folks are joining. I got 24 people here. So for my first live stream that I announced uh, 30 minutes ago, it's not bad. Okay. Um, Next question here. Let's see. I bought AFGW yesterday. Really cool, Paul. Time to buy Meta. Yeah, Meta's on a dip. Again, I don't think Facebook's really going anywhere. The only thing I've been, I have a Facebook, and it seems like it's so filled with like AI content nowadays, and it feels like you don't see really your friends stuff. People don't really seem to post things anymore. It's just becoming like this huge advertisement platform, and I feel like people are kind of losing that connection how Facebook was back in the day. Back when I was younger, everybody was using like MySpace, and it was like very personal, and it was like really exciting time. Then Facebook came around, of course. But right now, I think Meta as a company, they're sucking people's time out of it with all the shorts content, with all the ads that they have listed. Is really that's what they're banking on now. One thing that I would say primarily I use Meta for Facebook, which is like the marketplace. If I want to sell anything, if I want to buy something, secondhand, I think that's a really nice platform that they've built. That's really easy to use. So, is Meta going to be around? I'm sure it'll be around, but I feel like it might start losing its fan base for just the social aspect of it. So okay, moving down here. What do you enjoy better from Eric? Eric's journey. What do you enjoy better, managing your real estate portfolio or managing the income portfolio? I'll tell you this. This year has been really interesting because I've never really like paid attention to the stock market as much as I did this year. I invested into my IRA, my 401k for many, many years, but that's like automatic. I select the funds, it leaves my paycheck as I get paid. I really don't pay attention to it. And then once a year I log on, I'll say, "Oh, wow, like this account grew," or "Oh, this year's been really rough." So I really never paid attention to any financial news, nothing like that. So I had a little bit more, I think, peace. Now, with all this, this whole channel is built around obviously the stock market, dividends, everything, uh, and paying attention to what I'm investing in. It's a little bit emotional, especially on like red days. Like, back in the spring when I sold my property, I invested most of my money into these dividends. I pretty much picked like the worst time in history to invest it, because like a week or two later, the tariff were announced, and then my portfolio just tanked, and I was like, "Oh man, I made like a huge mistake." But I didn't give up. I didn't sell anything, so I just kind of stuck through it, and it worked out in the end. With real estate, I would say there could be some really quiet seasons where, as long as my tenants are great, and I've really kind of like nailed it down pretty good on screening tenants and stuff. So I really don't have many issues with tenants anymore. In the past, I've had some horror stories, but some I can have a few months where like nothing really happens, and I could have a month where like two things happen, like a fridge could break down or hot water tank leaks or something. But I'm at a point where I have a pretty good network of folks who help me out. So if it's like anything HVAC or whatever, I can just text my guy and he'll go out and take care of it. So it's a lot more. I think it's less emotional on me because if I look at, let's say, I can go on Zillow, I can see you know, the value that Zillow thinks my property is worth, and that value can fluctuate. Just on weeks, months basis, it can fluctuate by 10, 15, $20,000 throughout the year, but I really don't pay attention to it. I'm getting my rental income. That's really all that I care, and I know that long term that they're going to appreciate, and my mortgages are going to pay down, and I'm going to have even more cash flow. And that's really like the mindset that I'm trying to take to the dividend investing because uh, just learning how to react to the price fluctuation. And obviously, we had a combination between price fluctuation and just NAV erosion. And I think spotting that difference is really what's key in being successful in dividend investing is focusing on what your vehicles are, like what funds you're investing in, and what's actually happening to them. Are they just eroding because they're paying at the NAV, or is it just a market fluctuation? So I think to back answer that question, there's really different types of passiveness between these two vehicles. But obviously, if I need money right now, if I need to withdraw money, having this brokerage account is just phenomenal. You know, back in uh, back in the day when I just used like a regular checking savings account, it's like sometimes can be so focused on investing and paying that off that like you almost feel like like living paycheck to paycheck. On paper, you might seem like you're in a good position, but that lack of cash available really it gives you kind of an emotional toll as well because you feel poor. If you don't have a lot of money in your bank, you kind of feel poor and you might be stressing out, like make sure your checks don't bounce or whatever. So, having this good chunk of money in a portfolio that produces me income really helped me in that sense. Okay, we'll move on. Let's hop back to the comments here. Real estate has too small profit margin plus cash flow. Yeah, I mean, like realistically, I have a handful of rental properties. My cash flow from each one ranges between like $300 to $500 per property, but that's like if nothing breaks that year. So if I need to replace the roof, the furnace, whatever, I could be wiped out. Most of the money that I've made on real estate is in appreciation. So I got into it like right before COVID and right during COVID. And at least in my market, like all the houses just doubled in price after COVID. So I got really lucky that I went really heavy into it. So most of my money I made on appreciation and not really the cash flow. Okay, I'm doing exactly same strategy, Paul. Awesome. It seems like more time consumption headache, if you ask me. Yeah, I mean, starting out, it is a lot more work. Good morning, Alex. Hey, Jason. Good morning. Um, I think Meta will be reinvented possibly between real estate agents, closing costs, funds, fees, property tax, property management, blah blah blah. Your margin for error is razor thin. Yeah, I mean, you kind of have to know what you're doing. I've how I got really into it was I used to listen to a lot of Bigger Pockets podcasts, and that podcast like it was revolutionary. At the time, I worked a job that was pretty rewarding, but the hours were just terrible, and I was like thinking of like how do I get out of this situation? And I stumbled upon, like real estate investing. And at that time, I moved from one house to another and I kept my old house, which I rented out to some friends. So I kind of was already experimenting with it, and I decided to, hey, why not try to go all in on it? So it worked out for me, but I think the most important thing is you have to know your market. You have to know what the rents are, how much it's going to cost to fix up the property. So I like most of my stuff I bought within like 30-minute radius from from my house, and I've been pretty handy. Like most of the remodeling and stuff I've just been doing myself, and my father helped me out with a lot of it as well, just fixing properties up. So we'll move down here. Next question from Dividend Sif: how do you feel about two new tickers, T and KYLD? I don't know what this. Somebody mentioned this. I don't know if it was you. Dividend. Let's see here. Is that from Rex Funds? Okay. I just pulled it up on Google. Yeah, I don't know. I haven't really looked into it. Looks like it just came out what, like less than a month ago. Um, yeah, I'll have to really check it out. Let me make a note of that. Maybe I'll start a little notepad. Oh, by the way, Rex Funds reached out to me and they're like, "Hey, you want to have some free lunch and talk about our funds?" I'm like, I don't know. So it's kind of interesting with such a small channel. I'm already getting like these fund managers reaching out. So um, one of the things, like, I want to make sure, like, I don't want to sell out to any funds. I think if they suck, they suck. We have to be able to be honest with ourselves, with others. I know there's a few people in this space that kind of took advantage of shilling funds, so I don't want to become that way. Yeah, dividends. If I'll check those out, maybe I'll get a share or two. We can track it. Okay, Mark Hoffman. I found a new ETF I like. CAIE. It's super complicated, but numbers look good. That's right. If it's super complicated, then it's good. I'll have to look into that one as well. Calamus Auto Calable. Yeah, that's a mouthful. So that one's pretty recent as well. Yeah, I've noticed a lot more funds have been popping up. Fund managers have been popping out these days, so it's almost becoming difficult to keep track of the new ones. I think they're catching on what like Yield Max and Roundhill and Neos have done. uh, just how popular they became. And if you think about it, like their business scheme is pretty genius. I mean, they're making between 1% and 1.5% per year on all the folks who put this money in. And even if this fund just goes to zero, they still make all that money. So I think it's making a lot of other fund managers think about it and start pumping different products. So I'll check it out, Mark. Thanks for sharing that. Danger West, Gold Team, QLD will do exact same thing. If you like Gold, you like ULI and KUL. Yeah, so yeah, well, I guess we'll have to see what ULTI, how that's performing. Um, okay, so thank you for going live. Your updated port is the way I'm going portfolio. Okay, yeah. Thanks, Josh. I sold Alti on Friday after my last payment. Yeah, I mean, I didn't like. I don't want to give people financial advice. I want to let people know what I'm doing, and it's up to the folks to decide for themselves. I mean, there was a period where I got into Ulti, and I felt like I was a genius because I bought in at like $6 and some cents, and that same week I got the dividend, and then it moved up quite a bit, like 50 cents or something. So it was like I was up quite a bit, and I'm like, man, I'm really getting into this, cheap price. They changed their perspectives. They're paying weekly. The way that they're running these funds, and I was pretty excited. I'm like, man, this might be like life changer for me. So that was very short lived as I watched Ulti's NAV continue to go down, 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 down. And then I'm like, okay, well, how long am I going to hold this? I'm going to start getting to the negative. Yes, I'm getting my dividend, but it's not recovering. So I got out, and if it makes sense. I mean, some folks got in. They bought the dip. I mentioned this back in April, and they could have been really good for 6 months, getting all those dividends as they rode that OT price all the way to their average price, which would have worked out for them. Okay, Josh, any thoughts on close-end funds? Thanks. Dripping at the NAV is nice. Yeah, I mean, CLM, CRF, that's, I learned about those funds back in Christmas time last year. That's really like, I thought it was like something magical that nobody really knew about. So I bought in. So at the time I had Fidelity, and Fidelity, allowed the drip at the NAV for CLM, CRF. So I got into those, and then obviously the rights offering happened in the spring, and I lost like, I forget, it was like 20% or something on those funds. Now, granted, I didn't have a lot of money invested at that time, as I was just piloting with like $12,000. Um, I know back in the beginning of the year, I did do a lot of research on CLM and CRF. There's not a lot of content out there on it. There's a couple in-depth videos um, that talk about it. I don't want to I don't want to really give an opinion. I think people make money on it? Sure. Is it the product for me? I don't think so. One of the reasons I think some folks like to pitch those closed-end funds is, for it's kind of like a secret club, right? It's like you got to know how to play the rights offering and all this stuff, when to sell, when to buy. But really, after I did the research, basically the way that that fund works is it works off the people that don't know how to play it. So it's basically like the people who see their share price go down at the rights offering. That's the premiums that are getting paid, you know, to the rest of the folks. So it's almost like a legalized Ponzi scheme. Now I know the fund's been around for many years, and it's like a four-star fund, all this kind of stuff. Uh, Drip at the NAV. I mean, I'm in a position where I want the money right now. Okay, so drip at the NAV doesn't really interest me. Yes, I might get more shares of the CLM CRF fund, but end of the day, like I want to use the money right now. Okay, so I don't know. Like if we're looking like long-term future, like if you're young, like say like you're early 20s, whatever, and you're just looking like invest for the next 20 years. I think, best advice for folks like that would be like invest into growth. Okay, you're not going to get taxed on dividends. You're going to see your portfolio grow. That's like the best approach. For me, I'm in like this transitionary period. Like I want to build this so I can do other stuff and I can combine all my income streams and actually like leave my corporate job. So for me, it makes sense to do dividends, even though I'm in my 30s. So it's a little bit different, but I want that cash flow right now to have an income stream. With these closed-end funds, it's like it's not there or here. Like, yes, it's great that you're dripping at the NAV 20% each single month, but you can't really use those dividends unless you just margin against them and just live off the margin, I guess. But again, then you got to sell them, like twice a year around the rights offering. Like, I don't know, like it didn't appeal to me. So sorry to go on a long tangent here. Let's see. We got already 25 people here, so uh, pretty cool for first time. All right, moving down. Uh, well, Roundhill CEO of Granite Shares recently spewed out some nonsense. Jay from Yieldmex said have to reinvest 100% of divs of your capital will go to zero. Yeah, I mean I've heard folks talk about that. Yeah, it's just dumb. Like if you have to reinvest everything, like then just don't pay it because it just like you get the money, but then you got to give it back. Or even if, let's say you have to reinvest 50%. Well, instead of, giving me all that money, give me half of it so I don't have to reinvest it. Like I don't understand the logic behind it. Most round funds have been fairly predictable. Would you do your own cash secure puts or covered calls? Um, yeah, I haven't really like dove into that as much. I mean, I've played around with options this year a little bit. I made a little bit money. I lost some money. So, um, I mean, do we do cover calls on cover call funds? I feel like if you look into it, they're kind of like the premiums aren't that great. So I don't know if it really makes sense or not. I don't have experience. I'll just be honest. If somebody does and wants to share their stories, that'd be cool. Would you do? Let's see here. I still have Old T and TSYY, but Round Hill is interesting. Uh, Interesting, expensive though. Um, yeah. I don't know, Philip. You know, I'm not a fan of single stock dividends because they're so much more volatile. I mean, I've held Misty at some point, and I got out at pretty good price before it just sunk down. But a lot of these yield max funds, I know, just they were very short lived. I think people made money, but it was like within a few months. Um, I don't like, let's see, Paul, I don't like funds that require perpetual reinvestment. Yeah, that's exactly what I'm saying. Let's see, dividend SIF, YSPY, TQQI, very consistent. Holdings has same weekly payouts, not a big payer, but very consistent holding, better than XDT and QDT. No one really likes to talk about them. YSPY, yeah, I guess I don't talk about them because I don't know them. From Granite Shares. Yeah, I mean, they came out what this year? Looks like around $25. See if I can bring it up on here. YSPY. Yeah, so $25 launch price. We're down 21%. Yeah, they really came out like that was a terrible timing for them because they came out right before the tariffs. And very similar to XDT as far as what it's lost, really, like if we're honest. Um, and I mentioned that on my videos. Before the tariffs in February, we're at $50 on XDT. We went down to the depths of 39, and we're floating at 44. So we're still $6 or so away from when we were in February. So um, pretty fair. I guess I don't have much experience with Granite shares, so um, I'll um, I'll keep an eye on it. Thanks, Dividend. Josh, makes sense. Appreciate your opinion. I'm 46. I want to be more income, so maybe I'll adjust my position percentage. Okay, Mark, what is your average rate of return holding? How many ETFs? Yeah, so this one's it's a little bit tricky um, to just give you an answer on that. I wish it was that clean. And I'm not trying to be like elusive or anything. I transferred my portfolio from Fidelity back in the summer, and I've taken some money out. I've put some money in. I've sold funds. I've took loss on funds. So this year has been very like experimental, but so my history goes back to August, really, for for this portfolio. Um, if I look at the 3 month here, you could see that I'm up 11% in 3 months. Now this doesn't count the dividends, so I track my dividends every single week. I post a video on what I'm getting in dividends, and I think really next year, once we get into January, I'll be able to track more of like total return, all that kind of stuff. I had to like manually just sit down and like tally up all the money that I've actually invested like originally into Fidelity, all the money that I took out and how much I have left and do that math. And when I did that math back in I think it was like September time. And I basically looked at when I had majority of the money invested, which was back in like April, tail of April, and ran it through September. My the money that I've actually made, and what I mean is like actually made. So like whatever I invested minus what the account value is now, plus what I got in dividends. So that amount for the 6 month period was around $45,000 is what I made. This was back in September. I have to kind of re-update. It's a little bit of a manual effort, so I'll have to do that again. But I thought that was, I mean, for the first year experimenting with so much and like shuffling so much stuff around. Some people call me out. It's like, oh, you just keep shuffling stuff around. Like, yeah, like I want to experiment with the best funds. I want to make sure my portfolio looks great. Like I don't want this number to be red. Like I'm showing 11% in 3 months. Like I'm happy with that. If it was 3% green, I'd be happy. If it was 0%, I'd still be happy. Like I don't want it to be red. That's the whole point. So 45,000 within 6 months, I thought that was excellent. Okay, for the first year of doing it with the amount of money I had invested, I thought it was excellent. So yeah, I mean, you can calculate. At the time, I had like $250,000 of my money in there. Um, so whatever that return is, let's say it was even 20% for the year. It's not bad. Okay, so I think I've caught up on all my questions here. I don't know if we've been streaming for 36 minutes. I don't want to take up all of your morning. Like I said, this is a little bit of a pilot run for me. Um, I guess we got 30 people on here now. One thing that I've had people ask, and I mean, everybody has a Discord these days, but I'm thinking if you guys are interested, I might start maybe a Discord channel as well. Maybe if we do like a weekend call like this, maybe that way we can use voice and stuff instead of me just reading your comments. Are you doing anything for downside protection? Yeah, I mean, I looked into like buying puts and all that stuff. I did some research on it. Now, if somebody has, I guess, their own personal stories, how that has helped out for you, but from my research, it seems like it's almost not worth it because the premiums that you're going to pay for the puts and the likelihood of a large enough correction that they're going to be worthwhile is like that balance isn't really there. So basically you're going to be spending, hundreds of dollars every single month on these puts, and then chances of a large enough correction that these puts are actually going to, offset any of the losses, it kind of comes out to a wash. That's from my own research. Now I could be completely wrong. Again, I was reading online on Reddit, so on the forums that I could find. So what I'm doing for downside protection, uh, I lowered my margin. I'm at $50,000 in margin. Um, I'm paying off my debt, and I know like W Pay, it's been phenomenal this month. It's highly concentrated in tech. I understand there's huge risk behind that. I don't know. I guess I'll have to see what you guys, if you have stories on some puts protection and how that worked out for you. If anybody has anecdotal stories from April when we had the huge sell off, how that helped anybody out, I'd like to see that. Um, all right, thanks, Josh. Paul, I'm $15,000 margin, only 7 weeks to pay it off. Oh, that's amazing, Paul. Nice and safe. Okay, Jason, I went all in September. It's very, very volatile over the months. Roundhill has NAS, S&P, and Russell 0DT have been pretty good in keeping my capital line with my investment. What are your thoughts? Yeah, I mean, Roundhill, I had most of my positions in Roundhill. I had XDT, which was on the S&P 500, QDT, which was on the Nasdaq. The Russell I held briefly, and this was like earlier this year, but the Russell was just like doing poorly, and I was like, why do I have this money in here anyways? I just re-implemented into the larger cap stuff. So those worked out really well for me. Again, they are covered calls. I'm guessing that's the ones you're talking about, the zero DT ones. So on appreciation side, you're going to be capped, and basically on my analysis, I've come to the conclusion that, and I think this is part of the like problem that I have is like I want more money now. So something like that pays over 30% is like juicy for me. So the round hill ones that pay every single week. Whereas something like QQQI or SPY from Neos, like mathematically, they get ahead actually of the round hill ones. They run their funds much better, but they pay half as much, but they appreciate more. So long term, I think those make a lot more sense, and they make more sense with like I think more larger accounts. And let's say if I had $1 million, in portfolio, and I bought QQQI and SPY, and they're making me between 14 and 15%. Well, now I have $150,000 income, and I'm getting appreciation, and I'm not worrying. I'm not shuffling stuff around. I can withstand corrections. They bounce back. Uh, I think long term, those are like for me. Again, you guys do your own research, but long term, those make a lot more sense for me because they bounce back. I mean, if you look at just year to date on the Neos fund, okay, this is QQQI. We were at 54.26 in February before the tariffs, and we've climbed out of that. We are positive for the year. Whereas now again, this one only pays like 14 or 15%. Whereas QDTE, you're getting that 30% and you're getting weekly payments, but we didn't get out of that slump. And basically, it's like, do you want more money up front or do you want to keep your NAV in case of a big correction? And you've seen that, if you got in like at the dip, you're looking pretty. Like this run this year has been excellent. But I'm just thinking like if we have a large correction, 20, 30, 40%, these funds, they're kind of, they might screw us over. So those are my thoughts. Okay. We'll take a few more questions. We've been streaming for 42 minutes here now, so I guess we'll run it till 10 a.m., folks, and then we'll wrap it up. I got a lot of stuff planned for this morning around the house, so this has been great. Thanks for hanging out, folks. Um, all right, love seeing your investment style, mature, great job from Max Daniel Strauss. Hey, thanks a lot, Max. Appreciate you following along. I'm experimenting a lot, and that's the whole purpose of this channel is just to document what I'm doing. I can go back anytime. I can pull up any video from 3 6 months ago. I can see where my portfolio was at, what I was buying, mistakes I was making. So I think that's the whole point. We live, we learn. All right. TDAC and T-SPY Tap Alpha, very similar to Neos. Yeah, those are the new ones, right? I think I've heard of those ones. Tap, yeah. I was looking into those this week. Yeah, so these funds came out just back in September. Interesting. Yeah, I'll make a note. We'll track a margin maintenance only 25%, which was nice. Long term, long short equity on the Nasdaq. Pretty cool. That's pretty cool. Okay, thanks for that. Paul, I really like blocks. It has been increasing its NAV. Look at your date chart. It's a bit older than WPay. Yeah, so blocks. I had some Bitcoin exposure. I had YBTC, which I sold off because it was just, I don't know. I think like YBTC was one fund that Roundhill really screwed up. Like if you correlate like its performance with Bitcoin price, it doesn't even match up. So it's down 22% for the year. And I got in, I think, I don't know, somewhere in the summer, so probably in the $40 range. Um, so I got out of it. I cut my loss on that. I had BTCI. I was kind of in and out of it. BTCI is from Neos. This one's did better. Did better. Still red for the year though. And then somebody mentioned blocks, which I've been kind of buying up a little bit on the dips. This one's a little bit more mixed. It's not. It's not just Bitcoin. It has some other crypto stuff in there. Yeah, it's been growing quite phenomenally. Like right now, I have how many shares do I have? 225 shares, and yeah, I'm kind of flat on it. I think we had a little bit of a dip, and I just been buying into it pretty recently. So yeah, I like it. I wouldn't say that it would replace like WPay because it's very crypto centric. I like WPay because I like the underliers for WPay, and the funds that WPay holds have been around and have a track record. So, but thanks for that. Thanks for the live stream. Your first one, great info and opinions. Hey, thanks. YBTC is more singular stock. Yep, yep, that's right. Chippy, yeah, somebody mentioned this Chippy thing a few times already. It's on my investigate. Oh, it's from Yield Max. Now, I have some bad taste in my mouth, but you can't argue with this trend. I mean, this trend is pretty phenomenal. 25% growth. Um, yeah, I mean that's great. Yeah, that's great performance. So they did something right. Portfolio actively managed portfolio between 50 to 30 U.S. listed semiconductor companies, complemented by various complex option strategies. Ooh, complex strategies. Some of the holdings: Nvidia, Lam Research, Micron, AMD, Qualcomm, TSMC, Intel. Yeah. Okay. Cool. Yeah. I mean, with my luck, if I buy it on Monday, this will probably go down $10. So, um, I'll add it to my list, folks. I think this one's been mentioned a lot. Um, it's the trend looks good. I like that. I don't know what it pays in dividends. I'll have to research that. Um, okay, dividend SIF, BTCI, and blocks are my main Bitcoin holders. No one really captures the upside of Bitcoin well. Yeah, and that really kind of makes you wonder, like, does it actually make sense to just buy Bitcoin instead of buying these dividend ones? I mean, I, I know it all for me, it always seems like I'm buying Bitcoin at the high, and then 6 months goes by, and then it doubles in its price. So I've been kind of soul searching in that area as well. Maybe like I allocate, I don't know, just a couple $100 from every week that I'm getting from dividends and just buy Bitcoin itself. I've been listening to a lot of podcasts, and a lot of folks are really bullish on it. They've been saying that this is the the crypto that's going to be around, that's going to be used worldwide by all the institutions and stuff, and how it's going to fold in with all the AI, with all the quantum computing, and again, a little bit above my understanding, but it sounds like it's not going away anytime soon. Um, RMW came out swinging of the new six from Roundhill. Yeah, that the new funds that Roundhill has added from ARM. Yeah, yeah, we know it's a leverage product and we like it. So it's up. Wow. Let's see how much of a track record we have on it. That came out 51 bucks, I guess. Yeah, pretty choppy, pretty volatile. Weekly pair. Yeah, I mean I mean I like that they're adding more of these. Some folks were mentioning like we want WPay with less concentrate, less losers. Again, something that's a loser right now might be a winner later, or something that's a winner right now might be a loser later. So I like to see a few dozen funds. So I do like that they're adding some more. Uh, but who has 100 G's for Bitcoin later around? Yeah, I mean, you don't have 100 G's later around for Bitcoin, but you can buy shares like fractional of it. You don't have to buy the whole thing. So you can, if you have 500 bucks later around, you can throw that into Bitcoin, and that will, fluctuate with whatever Bitcoin price is doing. I can't imagine being Canadian. I'm sorry for you. I must have missed something. I don't know who's Canadian. I'm not Canadian. Any interest on KYLD or yeah, that was mentioned when we started the live stream. I wrote those two down. I'm gonna investigate, see how they perform. Okay, we got 45 people already here. Good morning, everybody. Thanks for hopping on. Icelandic Mongol 22. I like WPay a lot, but it's a swap or a flex contract. It's not easy to understand. It's basically an agreement between the two parties without too much transparency. The issue I see is that it is good now. Yeah, I mean the swaps that they're doing. I'll be honest. It's a new type of thing for me. I was doing a lot of reading around that, how that whole thing works with them, working with financial institutions and swapping. Basically, I think the way I understand it is the leverage that 120% on it, and with the appreciation that we're seeing with these funds is what allow us to get the dividend and to get that appreciation. Which, to many people's point, in case of a huge downfall, we will see that correction as well at that 1.2 times, with the way that this is leveraged. So it's different than cover calls, obviously, because um, we're not seeing NAV erosion so far. It's been great. Now, if you look at the individual holdings for WPay, you can pull up every single one of the tickers that it's holding, like the Nvidia one, Palantir one, AMD, whatever. You can see at those. Trend lines and how they have been performing. So they're a little bit mixed, but WPay, when it combines everything, it seems to be doing really great. And I love the way it's been recovering. I mean, I've covered it quite a bit on this channel. Just I mean, we just had a dip. Just this week we were down. Excuse me, down to $52, and we got back up over 54 bucks. So it's pretty crazy how it moves around. So the 3 months trend, we're booking, folks. We're doing great. So we're up 6% since launch at 50 bucks. Um, so very good. I'm up 1.9% on it. So, and that's aside from getting the dividends. Now I already got, let me see how much I got in dividends. So far I've made $4,700 on dividends, and I'm up $3,300, and that's only getting like 2 weeks full of payments. So it's like right now, it seems a little bit too good to be true. But same could be said about Ulti at some point. We were doing great. Again, I don't want this to be an Ulti. I have a little bit more faith in Roundhill. Have more faith in the fact that it's not managed the same way, and the underliers are solid. Uh, Okay, let's see. What will happen when a turn downward and parties do not adhere to these agreements? I'm saying because it happened in swap agreements. Yeah, I'm not sure. I don't have enough experience to tell you that. Is WPay a safe fund that you can hold all year long, in your opinion? I like the underliers. I'll just put it that way. And everything that I've seen, I mean, if and I've shown this, I don't know if I think I showed you guys this. So this is the tracker. So I'm just tracking all of the stocks that WPay holds. Okay, these have been doing phenomenal. I don't think Amazon's going anywhere. Robinhood has been a rocket. Like this platform, like it's gonna take out the big old dogs like Charles Schwab, Fidelity, E-Trade. Like they have to really compete with Robinhood. They're adding always new stuff, and it's this is the platform for millennials, for the Gen Zs, for the new generation, and they're gonna be biting a huge chunk of the market share. MicroStrategy, I mean, this company's been around, and I mean, we know that one of the reasons that it's so um, valued so highly is because the amount of Bitcoin they're holding. Coinbase, again, huge in crypto. Tesla, I don't think that's going away anytime soon with all the robotics and stuff we've been seeing. Palantir, it's like the military AI company. Netflix, I mean, people are still streaming stuff. Nobody's buying DVDs anymore. They have to compete with Disney. They have to compete with Hulu, with Amazon. So it is a competitive market, and we've seen that. Their earnings were not great, but again, is it going away soon? I'm not sure. AMD, I don't think that's going away. With the amount of data centers that are being built around the world right now, all of these tech companies are going to be getting a lot of orders for a lot of their chips, a lot of their cards, and everything that they're making. So yeah, I think these stocks that WPA is holding, they've been really great stocks. I don't, they're very solid. They're huge companies. These aren't small cap stocks that just kind of pop up. If you look at like I mean, if you look at Alti, a lot of Alti stuff was just like a lot of meme stuff. It was like companies that kind of blew up this year that they took advantage of, but I do like how established these underliers are. We're going to be wrapping up here soon, folks. I really enjoyed this morning with you guys. I'll take a couple more questions, and I'll wish everybody a farewell for the weekend. Um, I got some WP. It's too tech, though. It needs to add diversity. Yeah, I agree, Philip. It is very tech heavy. So there's no argument about that. And there's a lot of talk about like, is tech a bubble right now? Is all this AI stuff a bubble? Um, I don't know, but if it bursts, WPay will feel the pain 1.2 times as much as the rest of the market. Um, WPay will be turbulent for a few more weeks because it's earnings season. Yeah, good observation, Paul. There's a lot of earnings these last few weeks and next few weeks. Has NV, II, and TSSI been mentioned? I don't like single stock ETFs, but these have been pretty good. I have 10,000 each for a little fun. No, I don't think we've talked about those. I'm not familiar with them. These are rec funds. Uh, looks like it's leveraged on NVIDIA. Yeah, I mean, I could see it. Yeah, anything that holds NVIDIA is probably doing great. Okay, if we look at NVIDIA chart, I mean, it's what is it? The most valued company right now in the world. Year to date, we're up 50%. So yeah, I think you can't screw up a fund uh, if it's built around NVIDIA for this year. Um, Yeah, I mean, Rex funds, I think at some point beginning of the year I had like one of their funds. I forget which one it was, but it was kind of decaying quite a bit. So I left Rex shares after that. WPay is only 30% maintenance versus 50% Fidelity. Yeah, so when WPay launched, it was 100% at Robinhood. And then a few weeks went by and it went down to 30%. And that's when I got into it. Um, at the at the time it was 100%. I just had a few shares. And so yeah, it's pretty cool. One thing to know though, folks, um, if there's a huge volatility, a huge correction, uh, any broker can change the margin maintenance on it. So uh, you know, I, if you're holding a lot of margin and you're kind of winging it, and let's say it goes from 30 to 100%, you could be margin called potentially. So that's something to be wary of. And that's one of the things One of the reasons that I dropped my margin down so low because again, most of my money is tied up in WPay, which is pretty volatile, very tech heavy. And if Robinhood decides to bump that up to 50%, 70%, whatever, I don't want to be stressing over that. But yeah, Fidelity, I mean, every broker takes has their own formula when to adjust that. WPay should be a little bit more diversified with November balance of adding Costco, Alibaba, Uber, and Arm. Yeah, good point. They are adding those. And Costco's very solid company. I think it's going to do great getting into the holiday season. Alibaba, huge Chinese Amazon competitor, I guess. Uber, I'm sure Uber is going to have, it's gig economy, that kind of stuff. It's going to be around for a while. HTG, yeah, I hate Fidelity. They're limiting my growth because of their ETF rule. Avoid Fidelity if you don't have at least 20K starting capital. Yeah, I started my portfolio in Fidelity. I had, all my 401K, IRA, all that kind of stuff was in Fidelity. I had no gripe with them. Um, they did put me in like this waiting period prison, which one of the reasons that I left. So when I was messing around with OT, I like sold it, bought it, sold it at a loss, and they basically like put me on this 30-day hold where I couldn't use any margin, and I was just like devastated. So plus I got lower margin maintenance at not lower margin, I'm sorry, lower interest rate on the margin at Robinhood. So all right, folks, we're gonna call it a morning. That's gonna be a wrap. We've been streaming for an hour, so it's been really cool hanging out with you guys. Hopefully you enjoy this. Thank you for showing up. I mean, we had over 30 people in here, so it was quite phenomenal for last time thing. Um, we'll try to do this again, maybe next Saturday morning. So I'll try to do it in advance. Maybe on Friday I'll post and give everybody a heads up that we'll be streaming probably in the 8:30 to 9 a.m. Time frame. So I hope everybody has a great weekend. Thanks for hanging out with me, and good luck out there. Let's all make some money. So take care, folks.